If you have a service or a product and a paying customer, you have a business. However, if you want to scale up your business, probably you might need investment. There are many types of investments out there. One of them is venture capital money. My guest today is a venture capitalist. He explains the entire process of how to apply for VC money, what things they look for in teams and business plans before investing, what the risks, obligations, and expectations are. So if you are a founder looking to fundraise, listen to this episode of the Montrepreneur Podcast.
Okay, great. We are online. So,
Cool.
Michael, thanks a
Yeah.
lot. Okay,
Yeah.
great. Now,
Thank you for
Michael,
inviting me.
yeah, thanks a lot for taking the time, for sure. Michael, you are a venture capitalist. You have like more than 20 years experience like in the field. You also have like your PhD in economics. Before I introduce you, I love to hear your story from your mouth. Tell me, what's your background and why VC?
Actually, my background is finance, but not all the 20 years. I have VC and angel background. So, I spent more than 20 years in corporate finance until I realized that corporate world is maybe not so dynamic and maybe not so exciting and engaging for me. And then, thanks to Chicago Booth Business School, which provided me a lot of useful education and connection in terms of VC. And after completing Chicago Booth Business School in 2017, then I moved in 2018 towards angel investing and VC area. And actually at that time, together with my partners, we started Chicago Booth Angels, which is kind of angel syndicate for Chicago Booth alumni. And this was my kind of first steps on the VC journey. So I had my private investments before, but in terms of venture capital, it was my first steps. So it was like 6 years ago, a bit more. And this 6 year, it's quite a long journey and quite exciting one with its ups and downs, like in all the path. So it was quite exciting.
Sure, great. So I can imagine like 6 years, probably you met like very, very smart people, either from the side of investors or also like from the side of founders. So is there like any is there any story that you say, okay, that was like a story, that was a startup that you remember like from these 6 years?
Actually, one of remarkable stories which I remember and which I still invest currently. This is Altris AI, which is AI in ophthalmology with the founder from Ukraine, Andrei Kuropatnik. And he's also alumni from Chicago Booth. And I believe this is one of the successful deals which comes from the community and is invested by the community. So Andrei is alumni and he has a lot of investors from Chicago Booth. And currently, company is actually growing, and hopefully, like in some years, it will go to IPO and become a unicorn.
And what is it about? I mean, what is exactly the idea?
The idea is that we have a lot of there are a lot of disease of retina, which is an important part of the eye, which can be early diagnosed, and in this case they can be prevented. But because a lack of proficiency or lack of some data, the ophthalmologist cannot or either detect them too late or cannot detect them. And when we use AI and when we use data lake from a lot of patients, AI can support ophthalmology doctor providing some guidance and saying, okay, please have a look at these areas, so they might be problematic, or please pay attention here. Or, for example, don't pay attention at this area, so, I mean, they're all green and you don't have to spend your time checking all the scans. Because actually, like the one, when the OCT scans the eye, it's about 128 layers. And imagine how much time it would take for a doctor to look through this 128 layers. And of course, the computer does it much faster, and it allows to focus on key priorities, on key problematic areas, while not wasting time on the areas which looks normal and which doesn't need consideration.
Okay, great. And this is like mainly in the health sector. So do you focus like from your VC only on the health sector, or do you like invest in other sectors as well?
No, we are sector agnostic, but our verticals, which the main focus is health tech, AI, and Web3. So these and SaaS. So these are four main verticals where we focus our attention.
Okay, great. So if I am a founder right now, I have like a great idea, I have a proof of concept. I proved like someone is going to pay for that. I want to raise money. So when is the best time to come to a VC? Is there like any steps before that?
Yes. So you should do your homework. So like any process, fundraising have certain structure and certain stages. And one of the important stages is preparation. And for the preparation, you should create some of the materials which you actually send to VC, or which you preliminarily send for the future call or for the future talk. This includes the pitch deck, financial model, data room, and also you should be prepared in terms of like questions which you might expect to receive from VC. And if you do your homework properly, I believe your chances of like getting funded are much higher than if you don't, actually.
But when you say like do your homework probably, what do you, I mean, how do you evaluate that? For example, if I came to you with like all the documents you just mentioned, how do you evaluate that the data I just provided for you are valid?
There are two sides. So if to evaluate if the data is valid, there is like a side research. So I can cross-check some data which is in the presentation, on the preparation stage, on this initial communication stage. But also after after some time, there is a due diligence process which goes through the data provided in more detail, and like through the documents which the company has. So there is a cross-check of the data. So and it's really important to provide all data accurate, because actually I have some cases in my history when even signed term sheet was revoked after the due diligence when some data was not confirmed. So the data which presented in the initial stage was not confirmed during the due diligence, and already signed term sheet was revoked. So this is the one thing. And the second thing, it's not only like the formal documents which needs to be prepared, like pitch deck or financial model, but it also a lot depends what is inside, what is the content of these documents. And of course, I mean, there is certain structure which you should follow. But I mean, when you look at the documents, you can see how deep and how thoughtful they have been prepared. So, it's just formality. So there's a bunch of figures here and there, or like the financial model is very well thought through, and financial model really reflects the strategy of the company, and really reflects the operational activity, and really reflects the milestones. So like when I, for example, check these documents, I can see how deep and how deep was the preparation of these documents. And this is important because like if you see that this was kind of formality, then the likelihood of funding is very low.
Yeah, sure. I mean, you just mentioned right now, okay, so you investigate the documents, you start like the due diligence, you investigate like all the situation, all the data from these documents, and everything is fine. The data is perfect. There's a good chance, and you would like to invest. What kind of business models are attractive, for example, for VCs, or what should be like on the paper for you to invest?
But actually, business model should reflect the business itself. So, like, you should have the how to say, you should have the business model. Like, there's no like one business model which is the best for all. Yeah. So, like the particular for particular business, there might be several business models, and one of them might be the best, or like maybe several of them might be the best. In recent years, I mean, the most like widely known became the software as a service business model. And if we look at the data, I think about like 20, even 30% of all the startups funded represent the SaaS business model. However, there are discussions that current development in artificial intelligence will actually be able to replace SaaS, and SaaS will not be as efficient and as competitive anymore. So, if we check the figures, so SaaS is still high, but doesn't grow as much as it was growing before.
I understand. But like, I mean, I was like asking questions. The question maybe I have to reformulate it a little bit. For example, if we are talking about B2C and B2B, so is there like a preferred business model for you?
They're completely different. Actually, like for me, the preferred one is B2B. But there are a lot of angel syndicates and funds which invest in B2C. So they are very different in nature, and they are very different in metrics. For example, for B2C, it's usually like you grow much faster in the beginning because it's much easier to gain traction. It's much easier to convince B2C customer to buy your product or to sign up for your service. And if we talk about B2B, so like if a corporate client, for example, it's much harder for him to convince him. So if you're a company which was created, I don't know, half a year ago or 1 year ago, so it's hard to convince B2B customer to buy your product. But on the other hand, if we speak about retention rates, so they are much higher in B2B businesses. So once B2B business signed up for something, like if you don't screw up or if you don't fail, actually they stay loyal for many years. While B2C customers, they change their minds quite fast, and I mean they can cancel subscription in a few months or in 1 year or like at any point of time. So they are completely different, and usually what I see and what I like to see is that businesses start growing with B2C, but over time they try to switch to B2B and also get high checks from B2B and get high retention from B2B model.
Okay, cool. I get you. But is there any other challenges? Like you mentioned the client acquisition at the first from the B2B side, it's harder than the B2C. But is there any other challenges you experience over the year by the B2B model?
For B2B, the main challenge is that the sales cycles are quite long and actually unpredictable. So you cannot surely predict. So if you start, for example, customer acquisition now, you cannot surely predict if the deal is closed in 1 month or in 1 year or never. So it's really unpredictable, and one customer can change a lot. I mean, one customer can have 10% of your revenue or 20%, or I mean, so each customer is a really can have a very high share of your revenue, and that's why I mean, if some customer drops out, it can have a significant influence on your company, positively and negatively. While I believe in B2C space, the challenge is the customer acquisition cost, because actually, it's quite well known that like the advertising channels, like like Google, like Facebook, like LinkedIn, like others, so they're becoming more and more expensive, and like the customer acquisition cost goes year by year, and it's really hard to match the customer acquisition cost with the customer lifetime value. Take into account that also in B2C, the retention rates are not very high. So you spend a lot while you're acquiring the customer doesn't stay long and doesn't spend much. And you cannot say for sure if your customer acquisition costs finally pay back with B2C customers.
Yeah, I totally.
Your product should be really sticky, and your product should be really viral to really kind of get traction fast and to get traction with not so high customer acquisition costs.
Yeah, I can totally understand and totally relate for that. You mentioned like many technologies you invest in, Web3, AI, SaaS, etc. Do you usually like have technologists or like experts that really investigate the technology as well and the due diligence, or I mean, do you invest like in technologies you don't really understand?
Yes, of course. If I don't understand the technology, of course, I ask people who are familiar with the field, who are quite deep in the field, to investigate it better. So this is one way, or the other way is also to co-invest with other venture funds or with other syndicates. So in this case, you rely on the expertise of other companies who have invested in this project. So there's two ways: either either I myself understand quite well the field, or experts which can be asked some questions about this field, or the co-investors who have a very good expertise in this field.
Okay, great. So we talked about like the documents, we talked about like the plan, the business model, the finance model, but what other factors do you like consider when you look at the whole business or the whole startup, the team, the co-founders? Where is the company based, for example? I mean, what is relevant?
Yes, a lot of these things which you mentioned are really important. But actually, where the company is based is a more, kind of a go no go. So usually, I mean, the most beneficial for any company is to base its to reside in US. First of all, it's the biggest market, and I think it's 1/3 of the global venture capital market. And second, usually, like investors from other jurisdictions doesn't have any problem investing, for example, in Delaware C Corp. So anyone more or less gets used to it, and anyone, like in most cases, accepts it. Rather than, for example, if you set up your company in some European or like whatever might be the jurisdiction, a lot of US-based funds will not invest in this case, because like they need, in this case, they need to spend a lot on lawyers, on legal due diligence, on a lot of things. And if you have competition on the market for the money, so then they will just use like a next best opportunity when they don't need to spend this money.
Okay.
So this is like this is the suggestion: just to follow the standard way, open a US-based C Corp, and then if you reside in some other country, just open a subsidiary in this country, and this is the most probable structure which will cover most of the cases and which will be suitable for anyone.
Okay.
And if we speak about like the factors for which are important for the project itself, I think that team is one of the most important factors.
Mhm.
And in this regards, I mean, it's a lot of research done, like what should be the team and how the team influences the project. And actually, from my side, what I do personally, I look at the founders and like internally ask myself a question: is this guy can run a 1 billion company? So is this person able to run a 1 billion market cap business? So if I say yes, then like the team point is marked green. If I say no way, then most probably I will not invest.
Okay, but you are talking right now about the CEO or the leader of the team, right?
I talk about the main founder, like the main founder, or like the co-founders, if this is the case of two people founding the company. But usually, when it's two people, usually one is taking kind of CEO role, and the other takes some other roles. So usually, it's CTO, for example. So the one who is really deep in the technology, if it's a technological startup.
Okay, and what kind of characteristics do you look in the personality of the leader in this case?
Vision, leadership. Of course, his previous traction. So what has he done before? This is more like, I think this is the most factors.
Okay.
And actually, one of the important thing, I didn't see it yet, but I think for me it's really important. So if if I, for example, see that the person trying to cheat, or the person is not reliable, or the person is not transparent, so for me it's a red flag. I will not go.
Mm-hmm.
So far, I have not faced with such situations, but I think if I face it, if I see that the person is really caught red-handed, so I will not invest.
Okay, so we are talking right now about the C-levels, like the co-founders in the startup. But if we made a step back, what kind of skills do you need to see in the whole team to invest?
Actually, the team should be like it should be capable to fulfill like the idea which they have. Actually, it should be flexible enough because I have never seen a startup which actually where everything goes according to the plan. So like like in traditional business, which I worked a lot of time with. So if you have a business plan or you have a budget, and I mean you have kind of 10-20% deviation from budget. I have never seen a startup where it works like this. So it's always the case when then something goes completely different, then something goes not according to the plan. But like the strength of the team is that they still can manage, they still can pivot, they still can be flexible to adjust to the changing environment, to adjust to the changing circumstances, and they still survive and becoming stronger and grow even faster. So this,
Very
I think, is one of the most important qualities of the team of the startup, to be able to adapt to the changing circumstances, become even stronger, and use the circumstances in your favor rather than complain that like we didn't thought that it might be like this and blah blah blah.
Yeah. So like flexibility, adaptability, leadership, and like patience.
Yeah.
Okay, good. Is there like I mean, as a founder, if you just invested in that, as an investor, if you invest in that, so you have like a decision-making percentage in the startup, right?
Say again?
If you invested like as an investor, you have like a decision-making percentage in the whole startup, right?
It's not like you receive a share of the total equity. And then depending on the term sheet, you might have a board seat or you might not. So you might have a voting right, or you might have a decision power, or you might not have. So, but at least you should have information rights. So at least you should be informed what's going on in the company. And but actually, like angels and VCs are not frequently using their kind of power, because actually, it's like. You don't need to tell startup what to do. I mean, because like in this case, when then create a venture studio or then create your own company in this area. So what you need to do is you need to help startup avoid mistakes or avoid like wrong direction, but you don't need to tell them where to go. Because like this should be the strength of the team, and this should be the internal quality to really, actually the vision which I spoke about. So the founder should have a vision where he's going to go and what he's going to do.
Great. I mean, my question was actually like the first question of a second one, because I wanted to know if there is a big team, for example. So you have like many decision makers, and if you came as an investor, you think, okay, maybe we have to go this direction. The founders have like one vision at this moment, but in 1 or 2 years, maybe they have like 2 or 3 visions. So how to decide? I mean, what role do you like play as an investor in this case?
But again, I think the founding team is the main decision maker until it goes, very wrong direction, until it goes to bad. And also, we know like this cases when, and there's also one important thing that each founder should understand. So once you get venture capital money, it's actually the company for some part is not yours anymore. So it's you create kind of joint venture. You as a company founder and venture capital as an investor, and be ready that there might be a case in some future that you are not you're still a founder, but you might be not the best CEO for the company.
Sure.
Because like we know a lot of cases when there are brilliant technical guys and they would be the best CTO, but they are not the best CEO, and the company should hire, for example, a CEO, and the founder might move to CTO position, or like some cases which are quite remarkable on the market. When Steve Jobs, for example, was fired from his startup, or there was the recent case with OpenAI when Sam Altman was like almost fired, or there was like this like a conflict situation. So, but anyway, I mean, these are the cases which are visible on the market, but there are a lot of cases which are not visible on the market. And psychologically, as a founder, I mean, you should treat your company as your child, and you should make the best for your company, and maybe not all the time the best for yourself. So you should do the things which are best for the company. And sometimes it might be the case that you are not the best CEO. And in this case, you should either step out, or you should take other role in the company for it to develop in the best possible way.
Sure, I totally agree. So if we are talking about, like, you talked about the power you have, like in the startup, you said that the voting power is not necessarily like the case, because you have to determine that in the term sheet. What risks do I have as a founder if I took your venture capital money? If you don't have like a voting power, what risks should I care about as a founder?
No, I didn't. Maybe there's a bit of misunderstanding. I didn't say that there should not be there is a voting power, of course, and it's also, I mean, it's discussed in the term sheets how much of the voting power the VC has. But actually, the risk is in general, you should consider that part of your company doesn't belong to you anymore, and you are not the only one who runs this company. So this is a bit of kind of psychological shift. So before, I mean, the 100% of the company was yours, and you might take any decision, you might do whatever you want, and no one can say you no, or no one can say you anything.
Okay.
In the new situation, you have a board of directors which actually approves the budget, which actually does a lot of things, and you have two roles actually. When you take VC money, you have two roles. On the one hand, you are still the owner of the company, so you are the shareholder. But on the other hand, you are the CEO. And as a CEO, you really follow the decisions of the board of directors. And for some of the founders, this is really challenging.
Sure.
But in terms of risks, actually, board of directors can take some decisions which you don't agree with. And maybe if it was 100% your own company, you would not take such decisions.
Yeah, totally.
And also there are things which are also prescribed in the term sheet, which is called liquidation preferences. So, for example, if the company is getting acquired, or if the company doesn't perform very good, so actually usually venture capital funds have the term. Then the first money which comes to the company, for example, if it's sold out, it goes to VC. I mean, because venture capital is the latest investor, so first VC should receive back their money, or angels if they have such a clause in their contract, and only then the rest is distributed between the founder and the VC. So this is important to understand as well.
This is a good point.
It might be the case that even though the company has received some money back, so founder receives nothing.
This is a good point. I really would love to understand. So let's take a practical example. For example, I founded like a company. You are the investor. You have 20% of the company. I have 80% of the company. We made an exit. We sold maybe 30% of the shares. So for, I don't know, $1 million. You get paid first. And
let's consider. Usually, I mean, if you make an exit, you sell the whole company. So you cannot make an exit. I mean, only when you if the company goes public. In this case, you can sell 30% of the company. But usually, if the company doesn't go public, because if you sell 30% of the company, that means another round of investments. So usually, if we speak about exit, so that means that you sell the whole company.
Okay, so we made an exit. We sold the whole company for $1 million. So the first you get your money, and then I get. But I mean, I don't understand why you get your money first and then I get my money, because it's 20% for you, 80% for me, or not?
I will give you a few examples, and then you understand why. Okay. So let's consider first example. So you are the founder. You founded a great company, and then I came. Let's do I came as an angel, for example, and I invest. $3 million in your company. And then, for this $3 million, let's assume I acquired 30% of the company. So, I bought the company at 10 million post-money valuation.
Yeah.
And then like something goes another direction. You have some changes in your life, and you decided that you no longer want to do this business, and you want to focus on something else, on personal life or whatever. And you decided to sell this company for 2 million, for example. And then what happens in this case, if we don't have any clause of liquidation preference, in this case, we divide this 2 million like 30-70. So you receive 1.4 million, I receive 600,000. And then what happens? So you as a founder, you found a successful business. So you, for in few years, in 2-3 years, you made the 1.4 million. Not bad, actually, yeah? And what happens to me as an investor? I lost 2.4 million in the same business. So, I mean, and in this case, it's the same company, and you founder, I'm investor, you earned money, I lost money. Is it fair? I don't consider it very fair. The other case, I mean, we can take the same example, but let's consider that this liquidation preference term have been in place. In this case, if there was a 10 million valuation company, I put in it 3 million and had 30%, and I have liquidation preference. In this case, if you decide as a founder to sell it for 2 million, all 2 million goes to me, and then I lose 1 million because I invested 3 and I received only 2, and you get nothing because we all suffered. I mean, if we sell this company higher than the money which was put in this company, then we have something to split. But if we even was not able to cover the capital invested, all the money goes to the one who invested capital.
Okay, now I get that. No, that was a good example. But that means like the worst case for me as a founder is actually to lose like my time.
Yes, this is well, like this is exactly the point. So you as a founder lose your time, and me as investor, I lose time because like anyway, I spend a lot of time investigating the company and follow up, and anyway, like there's a lot of time spent on the company which are in the portfolio, and also like a lot of time spent to select the company for the portfolio. But on top of the time, I also might lose money.
Sure.
So like founder lose only time, but also like not only time. Actually, founder might lose also the time and money invested before the time when some new investors come. So it's also time and money on the one hand, and time and money on another hand. So this should be quite fair.
But sounds for me like it's a good deal for founders, because I heard like many times venture capital money is an expensive money, so I don't understand why they say that.
Venture capital money, like if you it depends like what you compare with. Of course, venture capital money is expensive if you consider that you sell the share of the company and the company is growing very fast. So if it's a good company, it's the valuation is growing very fast, and then it might be the case that in 1 year the valuation goes like 4 times. And for example, if you give like a 20% share for some money 1 year before, if the valuation goes 4 times higher, then you might give only 5% share of this company for the same money 1 year after. So of course, like venture capital money are expensive in this sense. But the question is, can the company grow fast enough without this money? And also, like, is there any other alternative how to raise money? Actually, there's an important point to consider that how to say, like, raising directly capital is not the only way how you can get funded. So if your company have already some revenue and have already some cash flow, then there are other options also available. For example, there is a venture debt. It's an option when you don't have so much of you don't have to give up so much capital, but on the other hand, you have to pay back this money. So you have to have a clear structure, clear vision how this money will be paid back. If you, for example, have a software as a service model and you receive consistent revenues, you can have this SaaS loans where you pledge your revenue and you get the loan which will be paid back from the revenue. And the creators in this case, they're first in line. They're before any other payments. So venture capital money are not the only source of funding at certain stage, but in the early stages, of course, it's the only source of money, and it's hard to say if it's expensive or not. I mean, there's a market. I mean,
Sure, yeah. I mean, what's the difference then from a normal bank debt then?
But there's a point. I mean, banks do not finance early stage companies, because like the early stage company has nothing actually in assets, because like banks, they like assets. They like real estate. They like equipment. They like something which you can give them, and then as a pledge, and then they give you the money. But what does the startup has? It has mainly some office, maybe not, because currently there's a lot of startups who are distributed worldwide. They don't have even a fixed space, or they have 2 square meters of space for only for address. And they have the team which is spread all over the world, and they have some products which bank cannot assess how much it should cost, or like is it valuable or not. So in this case, bank will not finance such early stage company, and actually usually bank come with the financing after company becomes profitable. So in this case, if the company becomes profitable, you don't need maybe so much investor money anymore. So the usual step in this case, and the most logical one, is to take debt financing for the future growth of such a company.
Sure. That depends on the stage for sure, and all the criteria you just mentioned. Okay, let's make a step back. You had like more, I mean, like you saw like over the years how technology changed, like the investments, the startups, etc. Would you say that the VC industry also changed with that over the years?
Yes, it's also one of the points that VC industry is changing and should change. So like any other industry, actually, and one of the changes which I notice on the market is, for example, use of artificial intelligence in venture capital. So there are a lot of projects who are focused on using AI in screening the projects, in screening the pitch decks, in because actually one of the problems, or it's actually the normal process of VC, is that you say no 99% of the time. So actually only 1% of the projects which have been considered or have been looked through, only 1% ultimately get funded, or maybe even less. So in this regard, AI can help really searching much more projects and searching them in a certain way. And there are some projects who are specifically focused on helping VC in selecting the projects based on metrics, based on some predefined KPIs. Like data-driven AI decisions is one of the areas which is evolving in venture capital. The other thing which is also I notice on the market is like a creation of new business models. So what is the usual business model? So usual business model is that the fund raises the money. Actually, like the funny thing is that not only the startups raising money from VC, but also VC are raising money from their limited partners. So from their investors. So VC really understand how this fundraising process look like. And so like usually the fund raises money from limited partners. Then it takes 2-3 years to invest this money, and then takes another like 3-5 years to grow. That the projects which I invested grow, and then only in after 10 years there is an exit. But there are different business models when it's not like VC is raising a certain amount of money at a certain point of time. Is when VC is constantly raising. So it's like ongoing raising and ongoing investing. So it's kind of evergreen fund. So you don't have a certain period when you raise, and the certain period when the fund should be liquidated, but it's ongoing. You're ongoing raising and ongoing investing.
Okay, I understand. And who are the limited partners usually?
Usually, like there are different LPs in this case. Maybe it's not mostly it's not institutional, but it might be some people who would like to put like some family offices who would like to put some share of their capital in certain area, but they do not want to put it one time, so they would like to put some percentage of their profit or some percentage of their assets over time. Or it might be even even some people who would like to with not very large checks, who would like to pay to put some of their yearly income to venture capital, and they for example are willing to put 20K per quarter for some investment, and they are willing to do so like several years in a row. So they are not ready to put 200K or 300K at one time, which is usually the usual limits or usual minimum check which venture capital funds accept. But they would like to put this 20-30K per quarter, which ultimately result in the same amount but over 2-3 years time.
Understand. Okay, cool. It's very interesting when you understand like the whole pipeline, because usually when you have no idea like about how the fundraising works, you think like it's like one person have like a lot of cash and just investing like no. But I mean, I am taking risk. You are also like taking risks. But we talked about the risks from the side of the founder. What are your risks if you didn't like achieve your targets, for example, for the fund if you consider the limited partners?
Your risk is evident. I mean, if you don't achieve the performance in your current fund, you will not be able to raise the next one. So I mean, if you don't perform, no one will give you money anymore, or like most probably will not give you money anymore. And also one important thing to consider here is to understand how venture capital economics works. So usually the most return for the fund is actually a few projects which really bring out outstanding returns, like 100x returns or 200x returns. So usually like half of the projects doesn't perform at all, so bring like from 0 to 1x. So they just just hardly pay back any money. Like another 30% or 40% bring like 2, 3, 4x. And only like a few projects, like 1, 2, or like really limited number of projects, bring outstanding results. And this outstanding results is really what creates the profitability of the fund. So if you take out those 1, 2, 3 projects, the fund will not be interesting for investors.
Yeah,
so this is why I mean everyone is asking like, why VC people are looking for these unicorns. Why they don't invest in like this average good project, which is like a normal business will become profitable. This is good. This is okay. The answer is that the whole business model of venture capital firms is to find these rare cases when the company becomes unicorn and when you make 100x your initial capital.
Can you say like from X amount of companies, how many unicorns you usually like meet or find?
I actually like I'm maybe early in this venture capital industry. I have not so far. I have not get any unicorns, but I hope some of my current investors will become unicorns.
Okay.
I hope these unicorns are in my future.
Yeah, me too. Okay, so I have the feeling that there's a positivity for the next 12 months, like in the VC market. I mean, can you say some words like why is it the case and what's going to change?
Yeah, there is like at the moment the market. So we hope we are at the bottom. So we hope that the market will not go down anymore. And there is a positive outlook for the next 12 months. You are right. And there are a few factors why this is positive. So first, like a lot of funds raised money recently, and they're sitting on a lot of dry powder. So they raised the money, but still have not invested those money. So the fund should invest. I mean, the fund cannot stay with money for a very long period of time. Otherwise, then this is not his goal. Yeah, the goal of the fund, the goal of the fund is not to raise money, but to raise and invest. So we hope that this money will be deployed soon. This is one factor. And the other factor is macroeconomics. So we see that in US, in other parts of the world, there is a tendency to decrease interest rates. And it's evident when the interest rates go down, there are much less opportunities for risk-free investment. And investors would like to take more risk. And venture capital is one of the most risky sectors. So that's why when the rate goes down, the money should come into venture capital.
Would that also reflect on the job market, for example, as well, positively, or what do you think?
I think yes. So usually when the rates go down, the companies get more incentives to grow, and then they hire more people. But usually on the other side, usually Fed or other financial authorities, they decrease the rates when they see that the job market is becoming weak. So when they see that there's not enough jobs, and when unemployment rate goes up, so in this case, they usually decide to decrease the rates to really kind of fuel the economy and to really boost the economic growth.
Which is the case right now.
So again?
Which is the case right now.
Yes. So this is why there is an expectation that like in next 12 months there will be several times of the rates cut.
Okay, that's great. Good news. Okay. I have like some questions for you. If there is like one startup imaginary that you would love to invest in right now, right today, what would that be?
I don't understand the question actually. So I mean, there are startups which are.
If you could invest like in any business idea in the world right now or any technology, what would you choose?
Actually, I would invest in the idea which uncovers human capital, because like a lot of people are now speaking about AI and how powerful is the artificial intelligence and so on and so on. But I really believe that if we also consider like the research, some of the research says that we use 3% of our brain or 6% of our brain or maximum 10% of our brain. So if there is a startup which really can uncover and at least allow us as a humans use like 30% of our brain or 50% of our brain, so like multiply our current usage of our capacity by 3x or 5x or whatever is amount of x, I think it would be really a brilliant idea in which I would like to put my money.
Okay, great answer. Okay, so you mentioned AI, and that would be my second question actually. Hype, or is there still opportunities?
It's like I don't think I mean anyone can say now like the true answer for this. Actually, what we can say that a lot of people, or at least we can name one company who is the biggest beneficiary of AI, and this is NVIDIA, which provides the chips for this AI. AI will require a lot of electricity capacity and a lot of data centers. So of course, like the electricity producers and the data centers providers will also earn a lot of money. But so far, I mean, investment which and a lot of money goes to this AI area. I believe it's more than 100 billion invested. This investment have not give yet a return. And if there will be a return or not, we will see. But there are a lot of things which AI can do, but I believe we will, and now there's a lot of optimism that AI can do almost everything. But still, I believe that like quite soon we will see a lot of areas where AI will not be able to perform as it was expected to.
Okay, great. Last question from my side. I forgot the question. No, I remember. We talked like about the numbers, about the documents, about the process, about the strategies. But is there like any personal philosophy, investing philosophy you have as a person when you look at startups, for example?
Actually, my personal philosophy is, I mean, to give money to people who can multiply them, rather than to give money to people who lose them. So this, I believe, is a win-win. So I mean, I multiply the money, and I multiply the human capital, which allows to multiply this money. So this is my personal philosophy, to grow the human capital, and together with the money which I put together with this human capital.
Okay, great. So you also like invest in people much more than the
Yes,
product.
yes. So I really believe that like the investing is all about people.
Okay, great. So, okay, from my side, I don't have like any more questions, but I would like to give you the stage if you would like to share like any stories, any advices that you think it's useful for this moment.
Actually, nothing comes to my mind. So maybe next time, maybe next podcast.
Okay, great. I really appreciate the opportunity and the talk. I really learned a lot and had some notes. Thanks a lot, Michael.
Thank you. Keep in touch.